If silver is about to shock the world again, the truth is this kind of move almost never happens. In fact, in modern financial history, it has only happened twice, and both times investors who ignored the warning signs regretted it. Most people think metals move slowly and predictably, but the rare moments when silver breaks that pattern are the exact moments markets remember for decades. Because when silver enters one of these historic phases, it does not climb politely. It jumps fast, scares institutions, and suddenly becomes front-page financial news across the United States. Right now, several signals look disturbingly similar to those rare historical setups. And if this pattern completes again, the next move may not look like a normal rally at all. Before we go deeper, if you want simple breakdowns of major market shifts before they hit mainstream headlines, subscribe now to Bullion Alert HQ so you stay ahead instead of reacting late. These early signals are exactly what this channel exists to track. To understand why this moment feels different, we need to look at the two times silver truly shocked the financial world. Because both events followed a surprisingly similar chain of pressure building quietly before exploding publicly. The first historic shock came when inflation panic collided with investor fear and aggressive buying pressure. Prices didn't just rise, they accelerated so fast that regulators and exchanges were forced to intervene. During that period, silver stopped behaving like a normal commodity. It became a financial battlefield between supply reality and speculative demand. The second shock happened decades later under completely different global conditions. Yet strangely, the psychological pattern inside markets looked almost identical. Confidence and financial stability weakened. Investors began searching for tangible assets they believed could not be printed or diluted. Once that shift in mindset spreads, metals often move faster than economists expect. Because the movement is driven less by math and more by collective fear and protection behavior. Today, several early indicators suggest the environment may again be approaching that psychological tipping point. Inflation uncertainty remains persistent even when official numbers fluctuate. Debt levels across major economies continue expanding. And geopolitical tensions keep reminding investors how fragile global stability can become. When uncertainty rises, while trust weakens, money naturally searches for perceived safety. Historically, that safety rotation often begins quietly before accelerating suddenly. Silver is uniquely sensitive to this transition. Unlike gold, it is both a monetary metal and a critical industrial resource. That dual role makes its supply balance much tighter than many investors assume. Industrial demand alone consumes massive yearly output before investors even enter the market. Solar infrastructure expansion continues requiring large quantities of silver paste. Electric vehicle electronics add another growing consumption channel. Medical technologies and defense systems rely on silver conductivity. These industrial needs do not pause just because prices rise. At the same time, mining expansion is slow and expensive. New projects often take many years before producing meaningful output. This means supply cannot instantly respond to demand surges, and whenever demand accelerates faster than production growth, the imbalance quietly widens. Most of the time, markets absorb this pressure without dramatic headlines. But when inventories begin shrinking while demand stays firm, the situation becomes far more sensitive. Large institutional traders watch exchange vault data extremely closely during these periods. Storage movements sometimes reveal stress long before retail investors notice anything unusual. For example, inventory tracking linked to the CME group can hint whether deliverable supply is tightening. When registered metal declines steadily, professionals start paying serious attention. Because futures markets rely on confidence that delivery is always possible. The moment participants begin doubting that assumption, behavior changes fast. More traders request physical settlement. Fewer roll contracts forward. Vault withdrawals increase. Liquidity suddenly feels thinner. This chain reaction has triggered historic price shocks before, and the early stages often looked boring right before the explosion. Another factor amplifying sensitivity today is the broader financial climate in the United States. Interest rate uncertainty, housing affordability pressure, and long-term debt expansion all influence investor psychology. When households feel their purchasing power slowly eroding, awareness of inflation protection assets increases. This shift usually starts quietly and spreads socially. A podcast mentions metals. A financial newsletter highlights supply deficits. Friends discuss inflation over dinner. Search trends for silver investing begin rising. By the time mainstream TV covers the trend, early accumulation phases are already finished. Late buyers often face higher prices and reduced availability. This is why historic silver shocks rarely feel obvious while forming. They only feel obvious after the breakout already happened. Right now, analysts are debating whether current industrial demand alone could keep markets structurally tight for years. If that assumption proves correct, investor demand would only amplify an already strained system. And that is exactly the combination that historically produced the rarest silver explosions. Not speculation alone, but structural demand meeting limited supply flexibility. What makes this moment especially interesting is how little mainstream attention silver still receives. Major stock indices dominate headlines while metals quietly build momentum in the background. Markets often move hardest where public attention is lowest. Surprise thrives in ignored sectors. If a true historical scale move begins forming, it will likely feel slow at first. Then suddenly it will feel extremely fast, because the real ignition point is never the first price increase. The ignition point is when investors collectively realize the move may not stop soon. And once that realization spreads, momentum tends to feed itself. Fear of missing access becomes stronger than fear of paying more. That psychological flip is exactly what powered the previous two historic silver shocks. And some early signals today suggest the emotional setup may again be forming. But the biggest question is not whether silver can rise. The real question is what specific trigger could transform today's rally into a true world-shocking event. And that trigger is something most investors are still completely overlooking. The overlooked trigger that often turns a strong silver rally into a historic shock is not price alone. It is the moment when physical availability suddenly feels uncertain to large buyers. As long as investors believe supply is easy to obtain, markets stay orderly. But the instant that confidence weakens, behavior across the entire system begins to change. Institutional desks start confirming delivery terms instead of assuming them. Procurement managers begin securing longer contracts instead of monthly orders. Dealers quietly increase inventory buffers to avoid future shortages. Logistics teams begin prioritizing confirmed shipments over flexible ones. None of these actions create headlines at first, but together they tighten the tradable supply faster than most public models expect. Once that tightening becomes visible in delivery times or rising premiums, the psychology flips. Buyers stop asking if they should wait for a dip and start asking whether supply will still exist later. That mental shift is exactly what powered the two historical silver shocks. It was never just speculation, it was urgency. Urgency spreads quickly inside financial markets. One large fund requesting physical settlement often inspires several others to follow. Futures contracts that were normally rolled forward suddenly convert into delivery requests. Vault inventories begin dropping faster week by week. The system can function smoothly under normal conditions, but it was never designed for a large percentage of participants demanding metal at the same time. This is why experienced analysts watch inventory classifications carefully. Reports connected to the CME group can sometimes reveal whether registered supply is shrinking relative to open contracts. If that ratio tightens too far, markets become extremely sensitive to even small demand increases. A single unexpected surge can suddenly move prices far more than expected. Industrial demand adds another powerful layer to this equation. Manufacturers cannot delay production simply because the market feels volatile. Solar companies still need conductive materials. Electronics firms still need precision components. Defense contractors still require specialized alloys. Medical suppliers still need reliable silver inputs. This constant industrial pull means investor demand stacks on top of already steady consumption. That stacking effect is what historically turns tight markets into explosive ones. Meanwhile, mining expansion remains slow by nature. Even when companies invest heavily, new production pipelines often require many years to deliver meaningful output. So, when demand accelerates faster than supply expansion, the imbalance compounds over time. Eventually, markets must correct that imbalance through price. Another critical element is monetary psychology in the United States. When households begin worrying about long-term purchasing power, interest in tangible assets tends to rise quietly. This process rarely starts with panic. It begins with curiosity. Someone reads about inflation persistence. Someone else hears about supply deficits. Financial podcasts start discussing metals again. Online search trends begin slowly rising. Retail participation alone does not create historic shocks. But when it joins institutional accumulation and industrial demand, the combined pressure becomes extremely powerful. This is why historic silver explosions always feel sudden to the public. The build-up phase happens quietly long before the breakout becomes visible. By the time major television networks discuss the surge, early positioning has already occurred. Late participants usually face thinner supply and higher entry costs. For viewers following Bullion Alert HQ, the goal is never hype or fear. The goal is understanding structural pressure before it becomes obvious. Because preparation beats reaction in every financial cycle, the calm investor with awareness usually outperforms the emotional investor chasing headlines. If silver stabilizes, markets may cool and rebalance naturally. But if inventories continue tightening while demand remains firm, volatility could remain elevated far longer than most expect. And if volatility combines with delivery stress, the rare third historic shock scenario becomes possible. Not guaranteed, but possible enough that serious investors watch closely. The important thing is not predicting exact price numbers. The important thing is recognizing when supply dynamics begin shifting faster than public perception. If that shift accelerates, price movements can compress dramatically into short time windows. What looks slow for months can suddenly move in weeks. That is why staying informed early matters so much. Financial history consistently rewards awareness more than prediction. If you made it this far, you clearly care about understanding the real forces behind silver markets. Drop a comment below and tell me honestly, do you think the world is closer to another historic silver shock? Or do you think this rally cools off first? Your answer helps shape what we investigate next here on Bullion Alert HQ. And if this breakdown helped you see the bigger picture, share this video with someone who follows inflation, investing, or financial markets. One simple share can genuinely help someone avoid reacting too late during a volatile market move. Awareness spreads faster when informed viewers pass information forward. Markets change, cycles repeat, and supply pressures build quietly before they become obvious. The investors who usually succeed are the ones watching early signals, not late headlines, because the next silver shock will not feel dramatic while forming. It will feel ordinary right up until the moment the entire world suddenly notices. Stay alert, stay patient, and I'll see you in the next update.